Every economic boom begins with a story. Sometimes the story is about technology changing the world. Sometimes it is about a new industry, a new financial innovation, a new source of energy, or a new way of doing business. The details change, but the emotional pattern remains remarkably consistent. Optimism grows slowly at first, then spreads through conversations, headlines, workplaces, and social circles, until confidence itself becomes a powerful economic force. People begin to feel that opportunities are becoming easier to find, risks appear smaller than they once seemed, and the future looks increasingly predictable. What makes this fascinating is that the same psychological shifts have appeared across many different periods of economic history, even when the underlying circumstances were completely different. Economic booms are not simply financial events. They are also social and psychological events. When economies expand, employment often improves. Businesses invest more aggressively, consumer spending increases, and asset prices frequently rise alongside growing confidence. As these developments continue, people naturally begin using recent experiences to form expectations about the future. This tendency is deeply rooted in human psychology. When positive outcomes continue for long enough, the mind starts treating those outcomes as normal, rather than temporary. The result is a subtle but powerful shift in perception. What once seemed exceptional begins to feel permanent. Behavioral economists often describe this tendency as recency bias. Human beings naturally give greater weight to recent events when making decisions about the future. If housing prices have increased steadily for years, many people begin assuming they will continue increasing. If stock markets have delivered strong returns over an extended period, investors may unconsciously expect similar performance indefinitely. This is not necessarily because people are irrational. It is because the brain constantly searches for patterns and uses available information to simplify uncertainty. The problem is that recent information is often the most visible information, even when it may not be the most important. History provides countless examples of this pattern. During periods of economic expansion, financial narratives often become increasingly persuasive. New explanations emerge for why old rules no longer apply. Investors begin hearing arguments that technological change has permanently altered valuation standards, that productivity growth has eliminated previous risks, or that financial innovation has made markets fundamentally safer. These arguments are often built on real developments. Technology can improve productivity. Innovation can create value. Economic growth can transform industries. The challenge is that valid observations sometimes evolve into exaggerated conclusions. One of the most interesting aspects of economic booms is how they change individual behavior. Early in an expansion, people typically remain cautious because memories of previous downturns are still fresh. Savings rates may remain relatively stable, borrowing may stay moderate, and risk-taking often appears restrained. As the expansion continues, however, caution gradually fades. New participants enter markets without direct experience of major losses. Existing participants become increasingly comfortable with higher levels of risk. Confidence grows not because risk has disappeared, but because risk has not recently produced visible consequences. This shift can be understood through a simple psychological mechanism. Human beings learn from feedback. When risky decisions repeatedly produce positive outcomes, the brain interprets those outcomes as evidence of skill, judgment, or favorable conditions. Over time, confidence becomes reinforced. If someone buys an asset and its price rises, they feel validated. If the same process repeats multiple times, that validation becomes stronger. Eventually, success may begin to feel predictable, even when uncertainty remains unchanged. The mathematics behind this process are surprisingly straightforward. Imagine an investor who experiences several years of rising asset prices. If annual gains continue year after year, the portfolio grows larger, confidence grows stronger, and future projections become increasingly optimistic. Yet the underlying reality has not changed. Future returns remain uncertain regardless of what happened previously. The mathematical danger emerges when expectations rise faster than fundamentals. At that point, prices may begin reflecting assumptions that are difficult to sustain indefinitely. Economic booms also create powerful social incentives. People compare themselves to friends, coworkers, family members, and peers. When others appear to be benefiting from rising markets, remaining cautious can feel uncomfortable. Someone who avoids speculation during a boom may watch others report impressive gains. Even disciplined individuals can begin questioning their own restraint. This social pressure is rarely explicit. Instead, it emerges through observation and comparison. Humans are social creatures, and our financial decisions are often influenced by the behavior of those around us. Historical parallels reveal how persistent this dynamic has been. Different generations encounter different assets, different industries, and different economic environments. Yet similar emotional patterns continue appearing. Excitement attracts attention. Rising prices attract participation. Participation attracts additional optimism. Optimism attracts more capital. The cycle can continue for surprisingly long periods because each stage reinforces the next. Importantly, this does not mean every boom is irrational. Many periods of expansion are supported by genuine innovation and real economic progress. The lesson is not that growth is dangerous. The lesson is that psychological responses to growth often follow predictable patterns. Another factor that emerges during booms is the tendency to underestimate rare events. When economies perform well for extended periods, downturns begin feeling increasingly distant. Risk models may rely heavily on recent data. Individuals may reduce emergency savings because stable conditions appear likely to continue. Businesses may increase leverage because financing appears inexpensive and manageable. None of these decisions necessarily seem unreasonable in isolation. The challenge appears when many people make similar assumptions simultaneously. Economic systems are complex networks of interconnected decisions. Households, businesses, investors, lenders, and governments all respond to incentives created by prevailing conditions. During strong expansions, those incentives frequently encourage greater risk-taking. Borrowing becomes easier, investment becomes more attractive, growth expectations become stronger. Individually, these actions may appear logical. Collectively, they can increase vulnerability to unexpected disruptions. This is why financial history often appears repetitive. The specific trigger for each cycle may differ, but the underlying human behaviors remain surprisingly consistent. People become optimistic when conditions improve. They extrapolate recent trends into the future. They adjust their behavior based on social signals. They become more comfortable with risk after experiencing success. These tendencies are not flaws unique to certain generations. They are features of human decision-making that appear across cultures, industries, and historical periods. Understanding these patterns does not require predicting economic cycles. In fact, one of the most important lessons from financial history is the difficulty of accurate prediction. Instead, awareness helps individuals recognize how emotions and incentives influence decision-making. When confidence becomes widespread, it may be useful to ask whether expectations are being shaped by recent experience more than long-term reality. When opportunities seem obvious, it may be valuable to consider what assumptions support those opportunities. When everyone appears confident, it may be worth remembering that confidence itself is not evidence. Perhaps the most useful identity shift is moving from participant to observer. Participants become absorbed by the excitement of the moment. Observers step back and examine the forces shaping behavior. They recognize that economic booms create both opportunities and psychological distortions. They understand that growth and optimism can coexist with uncertainty. They appreciate that strong performance does not eliminate risk, just as temporary setbacks do not eliminate opportunity. Throughout history, economic booms have repeatedly demonstrated the same lesson. Markets, industries, and technologies evolve, but human psychology remains remarkably stable. The stories change, the assets change, the headlines change, Yet the underlying mechanics of confidence, expectation, social influence, and risk perception continue to shape financial behavior generation after generation. Understanding these recurring patterns may not reveal exactly what happens next, but it can provide a clearer framework for interpreting the forces that drive economic cycles and the decisions people make within them.